Hey there. Are you thinking about selling on Amazon in Canada, or are you currently selling on Amazon in Canada? And either way, you just need a little bit of help understanding what all is involved from a tax perspective. I think that's the big thing that keeps a lot of people, from what I've heard people tell me along the way, that keeps people from selling in some of Amazon's international marketplaces is, how is that going to affect my taxes? Like, there's this big boogeyman who's going to come down and get them because they didn't do it all right. So at the end of the day, it's all about just making sure you're attempting to do the right thing and keeping your nose as clean as possible. And so to help us keep our nose as clean as possible, I am excited to have with me here today Michael Fleming from Sales Tax and More, who's not just an expert in Canadian related taxes, but he also, because he's US based, he also understands the US sales tax and income tax code. So very excited that Michael's here to help clarify things, especially if you're a US-based seller, on how that's going to affect your US taxes, as well as what you need to do to make sure you're compliant in Canada, because it can be a great source of revenue for you and for your business. So Michael, thank you for being here today.
Well, thank you for having me, Kevin. I'm happy to be here and answer what questions we can.
Awesome. Well, let's go ahead and dive right into it. So just from a high level perspective, can you describe some of the differences from a sales tax perspective? What is different and what is similar, I guess, so to speak, between the US and Canada, and how sales tax works?
Yeah, absolutely. And one of the biggest differences is that there are two levels of tax in Canada. So we have the federal level tax, called the goods and services tax, which is actually not even a sales tax, but a value-added tax, or a VAT. And then we have the local level taxes. These taxes are at the province level, and some of them are VAT, value-added taxes, and some of them are actual sales taxes. So that's the major difference. Now, when we're talking about a value-added tax, some of you may be selling overseas already. The value-added tax is a little bit different than the European value-added taxes, because the tax is not included in the price. It's more like the U.S. It's actually added to the price, and it's stated separately. So it's a little bit easier than computing your sales price from the overseas VAT, which is included in the sales price. So that way, Canada is a little bit more like the US. In a value-added tax, though, there are no exemption certificates. Pretty much tax is paid at every step of the supply chain. So the way that Canada prevents double taxation is by having what's called an input tax credit. So an input tax credit simply means that any VAT that you pay in the normal course of your business, when you're filing your returns, you get to file it less any tax that you've paid. Any tax that you paid in the normal course of business, you get to recoup that. So you're really only remitting the net difference to Revenue Canada. So that's a big difference between the U.S. and Canada when it comes to who's required to pay the tax. Pretty much everything is taxable for the GST. When you get down to the actual sales taxes on the province level, those are much more like the U.S. sales taxes.
Okay, great. So let's just get right into it then. From you said a value-added tax. So for those who aren't familiar, because here in the U.S., like you said, it gets charged on by the on top of the price, as well as from the standpoint of the value chain, so to speak. So the supply chain. If you're buying from your supplier, you're not paying sales tax generally on that. So you are in Canada. So where would someone who's a US-based seller, let's say, just assume someone's from the US or from outside of Canada, really, for that matter, when would they be paying GST they could recoup, and then how would they recoup that?
Okay, so for the typical Amazon seller who's selling on Amazon Canada, there are two places where they're paying VAT, the GST or the HST.
Okay.
HST is actual some of the local taxes There are 5 provinces that have said, you know what, we're going to make this really easy. We're going to make our rules almost identical to this goods and services tax, the GST. In other words, we're going to harmonize, and that's how we get the HST. And when you register for the GST, you're automatically registered for these 5 provinces. So you could be paying GST, you could be paying HST, but when you're clearing your goods, when you're sending your goods to the Amazon warehouse, whoever's clearing customs for you is paying a 5%, what we call a Division 3 GST. Some people refer to it as the cross-border tax, but that's being paid by your logistics person. Sometimes you don't even know that you're paying it, but if you look at your invoice, you'll see that there's 5% being charged on the cost of your goods. So that's one area that you can get the money back. The other is on your Amazon fees. So in Canada, as we mentioned earlier, pretty much everything is taxable, and your Amazon fees are taxable. So if they're in British Columbia related to the warehouse there, then you might only see a 5% GST. But if they're in Ontario, which is one of the provinces covered by the HST, then you're going to see a 13% added on to your Amazon fees. So typically, if you're selling $1.5 million or less, you're going to be an annual filer. So at the end of the year, you add up all of this GST and HST that you've paid. You add up all of the GST and the HST that you've collected, and you subtract what you've paid from what you collected, and you only remit the net difference to Revenue Canada.
Okay, great. So if I was to say, okay, it sounds like this is something I need to do, because here in the US, there's the perception, even though it's becoming a little bit more black and white, but there's still a perception that it's still a little gray with where you need to get started and where you don't. So if I'm just getting started selling in Canada, what would you recommend would be my first step?
Well, it all depends on how big your shipments are into Canada. So,
Okay.
If you're just starting out, you're sending up 100 units and they're, $10 units, you might want to hold off and see how your sales are going to take off. But unlike the US, there's that financial incentive to get registered sooner rather than later in Canada, because this cross-border tax, this 5% that you're paying, that's a hard cost. The only way to get that money back is by getting registered with Revenue Canada. And once you start collecting the tax, then you can get credit for the tax that you're paying. So, you don't want to start too early. You want to make sure that this is a successful venture for you, but you want to start as soon as you're sending any type of material inventory into Canada, because otherwise you're just cutting into your profits there.
Yeah, I agree. I definitely think it's worthwhile because it's 30,000 is the threshold, right? In Canada, 30,000 in worldwide sales that you have to.
It's actually 35,000, but you're right.
Oh,
but it's in worldwide sales. It's not sales into Canada. So, if you're starting to sell into Canada, you're a U.S. seller. You probably got sales in the U.S. And those sales count in that calculation. So,
and just for the sake of clarification, when they say 35,000, do they mean if I look in my US Amazon account and I see I have 35,000 or more in US dollars, or is that different?
It's in Canadian dollars. So, the US dollars are worth more than Canadian dollars. So it would be less than 35,000 here in the US before you hit that threshold.
Okay, gotcha. So it might end up being like 26,000 US. I'm using some very rough back of the envelope mental math, so it could be a little bit off. But yeah,
it sounds good to me. Yeah, it's not an exact number, but somewhere in that range, absolutely.
Gotcha. So generally speaking, if you've been selling for any length of time and you have at least, let's say, 20 to 25,000 US dollars in sales, it's probably going to be at least worth your while to register for the GST, HST, because you're probably going to have to anyway at some point. And then to your point, you can also recoup some of those costs, with what they're charging on top of your fees, which adds up pretty quickly in Canada from my experience, as well as what you pay at the border.
Yeah, absolutely. And one of the other great things about Canada, or one of the differences between Canada and the US, is the filing frequency, at least on the federal level. You can have up to $1.5 million in sales for the GST and still be an annual filer. So you only have one return to do per year, which if you had $1.5 million in sales in the US, you'd probably be a monthly filer in a state, or perhaps even a prepayment. So that's another reason why I think that it pays to register sooner rather than later, because your cost of compliance is not going to be as high in Canada as it is going to be in the US.
Great. So it's always good news to hear when cost of compliance is not as big of an issue as many people might think it is. Okay. So you talked about how we have to file annually if you have $1.5 million in Canadian dollars in sales. Now, is that worldwide sales, or is that just in Canada?
That's just in Canada.
Okay. So in my experience, most people, it tends to be about 10 to 15% of their US sales that they will see in Canada. So it's a nice addition, but then again, we're talking about, to plan on being a more than annual filer, you would likely be doing, this is very back of the envelope math here, but probably about 7.5 to 12 million US dollars in sales in the US to be likely seeing 1.5 million Canadian dollars in Canada or more. So it's probably not going to happen for most people right away. Hopefully it does get to a point that you need to file more often than that, because that's good news that you're doing more than $1.5 million in Canada in additional revenue that you wouldn't have been doing if you didn't put your products up there. So, okay. So that's good. And then unlike in the US, as you talked about, you could take off what you paid into the system along the way. What kind of documentation do you need for that?
Just the invoices. So typically, whoever your logistics provider is going to be giving you an invoice. Some of them sum it up very nicely at the end of the year for you. But if they don't, you just keep your invoices, and you can see that 5% that's being paid, and you just keep track of that. And then Amazon very nicely sends out a summary every month of the taxes you've paid on your fees. So those are the only documents that you need for this. If you're selling outside of Amazon, you get a little bit more complicated, but everything is pretty much in Amazon or in your logistics fees. That's all the information you're going to need to do that annual return. Or if you're really successful and you get over that $1.5 million, it'll be a quarterly. And then if you get up to 6 million, that's when you become a monthly filer.
That's awesome. I would love to get to a point of being a monthly filer in Canada, because then that would just mean that I was doing that well, 6 million in Canadian dollars, which would be about 4.5 million US dollars in sales, which, it's a nice little add-on into what I'm already doing in the US. So, okay. So, you're making it sound not all that hard to get into Canada, and it actually makes it seem like it's a little bit more streamlined. Now, once you register, what are they going to send you? Are they going to have any additional forms beyond the registration form, which the registration form, in my experience, is no more difficult to fill out than, say, a passport application or, getting your driver's license? It's pretty simple.
It's pretty simple. You can't use the online process because in Canada, instead of social security numbers, they have social insurance numbers. Mm-hmm. In order to use the online system, you have to have a social insurance number. So everything has to be done by fax. So it slows the process down. There's 2 offices, one in the East Coast, one on the West Coast. So it depends on where you're located as to which office you're going to file through. The East Coast office is habitually slower than the West Coast office. West Coast office can be as quick as 2 weeks. When it's slow, it's 6 weeks. East Coast could be 3 to 4 months when they're really backed up. So that's one of the big things. Unlike the U.S., which it's generally very quick, it can be a very lengthy process. When you are approved, let's say the approval takes 4 months, they're not going to look at your application date. They're going to look at the date you're approved and say, unless you can prove to me that you've been collecting the tax, we're only going to go back 30 days. So in the US, you're technically supposed to wait until you have your approval before you start collecting tax. In Canada, you want to start collecting tax right away. And the reason why this is important is you can't take any of those input tax credits from a period when you weren't registered. So you want to be registered as soon as possible, which means that you want to start collecting the tax as soon as possible. And when you go to get approved, they're going to say, have you collected tax? And where in the US, that might be a bad thing to say, yeah, I've been collecting tax. In Canada, you need to say yes. And then they'll say, okay, get us 5 invoices. And from the date that you started collecting the tax, and we'll backdate your approval to that date. And this way, if it's 4 months in the future when they approve you, rather than just going back, 30 days, they'll go back all 120 days. And now you can get those input tax credits from that period from when you started collecting the tax. So that's one of the things that they're going to ask you right before they issue the approval. When they do issue the approval, you're going to get a package, and there are going to be a couple of papers in there you have to sign. One is about books and records, where are they going to be kept? And if you're keeping them here in the U.S. and they need to come and inspect your books, you got to make them readily available to them. And if they need to travel here, you agree to pay for the travel expenses. So that's one of the papers that you'll get. The other is there's a surety bond that needs to be filed. And most people, when they're first signing up, you don't know what your volumes are going to be in Canada. So if you believe that, they're going to be less than $100,000 and it's going to be less than $3,000 net GST that's paid, you can write that down in the surety requirement. The security deposit is waived. And that can be a pretty big number. It's minimum $5,000 and up to 50% of the previous year's GST. So you get up to $1.5 million. That's let's do $1 million. It's easier math. And you pay in, something like 50,000 Canadian dollars. Well, your security deposit could be 25,000. But as I mentioned, if you fill out the paperwork correctly, there will be no security deposit just starting out. Canada, when you cross that in future years, would like you to put in the security deposit. Very few of our clients actually do. Who wants to have their money sitting up in Canada? But if you ever do a refund, Canada is not going to return that money to you. They're going to put it towards the security deposit. But, in all the time that I've been doing this, I've never seen Canada refuse to accept returns and accept money in the normal, cost of paying the GST if you don't have that security deposit on file. And I've never seen anyone penalized for not having it, other than you can't get any refunds that you're due without having that on file.
Okay. Yeah. So I have yet to be required to do it. And I'm in my, 2016, 17, 18, 19. This is my 4th year selling on Amazon in Canada, and they haven't come back to me and said I needed it. I'm probably getting close to the threshold net of needing to do it. So once I do hit that threshold, let's say now in my 4th year, when I go to file next year, they say, hey, I need to put in a surety bond. You said they're just going to base it off of what my previous year's sales were?
Previous amount of GST paid. So 50% of the GST paid with a minimum of $5,000.
Got it. So then let's say it was $3,500, or let's say 4,000. It's easier math. So I paid 4,000 Canadian dollars in GST, hypothetically. So then let's say 2,000 they're going to require me to send in a security bond, and then but it's really going to end up being 5,000, which seems a little harsh. But then again, now I'm in my fourth year and I've made profit for years off of it. So, and this is based off of just the percentage for GST. So this is actually a fairly low percentage of my overall sales. So that $5,000, and this is kind of for my own knowledge here, that $5,000, does that go towards my following year's GST? So let's say I owe 3,000, or sorry, let's say I owe 5,000 the following year. Does that all 5,000 go to it?
In theory, anytime there's ever any change, you would have to add to it. So it's not 5,000 per year. Your amount would still be 5,000 in the example we're talking about. So there'd be no change. You wouldn't have to add anything to that security deposit. If it was 10,000, let's say, then you've got 5,000 there already. You would have to come up with another $5,000. So anytime it goes above the security deposit that you have there, you're supposed to be adding to it. Now, supposed to and actually do are two different things. So very few sellers out there, even when we get away from Amazon,
right.
A lot of sellers just, they don't pay attention to that. And Canada doesn't really give them too much of a hard time because now you've got a history of paying.
Right.
So, like I said, technically you're supposed to do it. In reality, a lot less companies do it than you would initially think should be doing something that
should be
requires.
Deposit. Okay. So it's most likely, from everything you're saying, not something the run-of-the-mill seller coming in their first year is going to have to put 5,000 Canadian, which is like 3,700-ish US dollars, into an account with Revenue Canada right away. So it's not like you have to spend all this money to get there.
No, so long as you fill that paperwork out correctly, you got to pass on the first year pretty much automatically. And then after that, you can figure it out on whether you're supposed to pay it or not. But if you're under $100,000 and under that $3,000 net, then there is no requirement. So,
okay,
for the typical seller, it doesn't become, like you said, you've been doing it for 4 years, and it hasn't become an issue for you yet.
Gotcha. Exactly. And the way I look at it is, if you think because you're a fairly high volume US seller, and you think that might become an issue, so then after year one, just take whatever profits you have, put it off to the side. Because remember, this is a long-term channel bringing in additional revenue that you wouldn't have had otherwise, because Canadian customers typically aren't cannibalizing your US sales. They're distinct and unique. Now, one of the scary things that I see in that little packet that you get after you register is the whole thing about you might have to pay travel expenses. Have you had clients that have had to pay for travel expenses for Revenue Canada to come down and look at their books?
Number one, Revenue Canada is a lot less aggressive than any of the states here in the U.S. So yes, they do audit sellers. However, it's a lot less infrequent than it is, or a lot more infrequent. It's a lot less frequent than it is here in the U.S. So, and when they do, generally, it's sort of similar here to the U.S. I mean, you can do an audit remotely, especially if you're an e-commerce seller and they don't have any facilities to inspect or anything else. A lot of it is just done remotely. So I have yet to hear about one, nor that in addition to what we experience. We've never experienced it, and I've never heard of anyone experiencing it, but it could happen.
Right.
So,
There's always that potential. But the way I've always looked at that is having worked for large organizations and having, at least in the US federal government, family members who are retired from the US federal government, you have to justify your time. So, if someone's paying, let's say even 10,000 Canadian in GST, the fact that they might find another few hundred Canadian or maybe even a couple thousand Canadian dollars is probably not enough that they have to justify to their bosses why they went, even if it was reimbursed by the auditee, so to speak, that it wouldn't make sense. Like just knowing how companies work. So that's kind of the way I've thought about it. Like, unless they thought you were like, selling, hundreds of millions of dollars in sales and you're only reporting, tens of thousands, then maybe they may come after you more.
yeah, if you were excluding your wholesale sales and they caught wind of that, but the way that it's supposed to happen, you collect tax on all of your sales and you get this input tax credit. So, so long as you realize what the rules are, then they're fairly easy to comply with. Because you're almost immediately, it's not a whole lot of money out of your pocket. The cost of compliance doesn't really change because you still got to get up over that $1.5 million mark or the 6 million mark in order to change these frequencies. So that's one of the reasons why we see, in my opinion, why we see a lot less audits, because there's greater compliance in Canada because they're making it a little bit easier for sellers.
Gotcha. At the end of the day, I truly believe they want us to come up there and sell. It's not like the Canadian mounted police are going to come to your door. How dare you try to come in here? They want our products, and we're providing a service. That's the way I'd like to think of it. So we've talked a lot about GST and HST, which are basically, even though they differ by province and the amount, but they're all federal. We're all paying to the federal government. But there are, is my understanding, instead of GST, HST, there's also like PST, provinces. Can you just go into a little bit on that and what that means and how that might affect some folks?
Yeah, absolutely. Let's start a little bit higher than that. Number one, there are 10 provinces in Canada and 3 territories. So for the GST, that's collected everywhere. So once you're registered for that, you've got to collect it everywhere. And Amazon does that very smoothly, very seamlessly for you. On the local taxes, we talked about the HST. So there are 5 provinces, and they are, I probably should have written this down, New Brunswick, New Bedford, Labrador, and Newfoundland, Ontario, and Prince Edward Island. So, those are the 5 provinces that have harmonized. So it's the HST.
Okay.
All right. Now, when we get to the local taxes, Alberta, which is one of the 10 provinces, has no local tax at all. So you only have to collect the GST there.
Okay.
3 territories have no local taxes. So you only collect the GST there. And then you have, collectively they're called the PSTs, or provincial sales tax. So you've got British Columbia, which they actually call theirs the provincial sales tax. You've got Saskatchewan, which they actually call theirs the provincial sales tax. You've got Manitoba, which actually calls there the retail sales tax. So if you're referring to them as a group, you call it a PST. But if you're talking to Manitoba, they'll say we don't have a PST. We have a retail sales tax. That's an RST. Same difference.
Gotcha.
Those 3 are actual sales taxes, and they're very much like the sales taxes in the U.S. Then you've got Quebec, and Quebec has the QST, or Quebec sales tax, but that's almost identical to the HST. That's actually a value-added tax, or a VAT. Quebec's just got to be a little bit different. Right now, FBA sellers don't have to worry about Quebec. But if they ever put a warehouse there, then it gets a little bit more complicated, because now, instead of the GST all being filed with Revenue Canada, any GST from Quebec gets filed once you register for the Quebec sales tax. Now you have to file any of the GST related to Quebec with Revenue Quebec. So if you don't register for the QST with the Quebec sales tax, then that Quebec GST gets filed with everything else under Revenue Canada.
Right.
And the rules are basically the same. Instead of having input tax credits, they have input tax refunds. But it's the same exact mechanism. And the rules for the HST and the QST are pretty much the same. In case you haven't gotten it, I generally refer to Canada as the alphabet soup of taxes.
Right.
We've got QSTs, RSTs, HSTs. So if you wanted to go out and register everywhere, which we don't suggest, but if you did, unlike the U.S., which there's 46 plus registrations, in Canada there's a maximum of 5. And right now, Amazon sellers, you've got the federal level GST, and then you get the automatic 5 provinces. When you register for the GST, they automatically register you for the HST, and it's all one return, and it's all collected together, and Amazon will handle all of that for you. You've got to file it, but it's that annual filing. So that's very simple, very easy. British Columbia is the next province. There's a big Amazon warehouse there, and they're a little bit more aggressive than Revenue Canada themselves. So once you start getting some volume in British Columbia, then I suggest that's the second registration that you do. As of now, there's no need to do anything in Saskatchewan, Manitoba, or Quebec. So a possible of 2 registrations in Canada. Now, the bad news is British Columbia is generally going to be a monthly return. So your cost of compliance is a little bit higher there. There's no rhyme or reason to what British Columbia does. It's not like they have thresholds like Revenue Canada or even any of the U.S. states. For a while, we were getting all quarterly returns, and now we're getting all monthly returns. And after 6 months of filing, you can request them to change your filing frequency, but it appears that everyone right now is coming out of British Columbia as a monthly filer.
Okay, that's good to know. Now, you mentioned once you get up to a certain significant level of sales in British Columbia, when would you say, or what kind of general threshold? I'm sure it's not a black and white answer, but is there a general threshold you give?
No. The sales tax in British Columbia is 7%. So you just got to work into the numbers yourself. Generally, I say if your sales into, this is the U.S., I use 3,000 as a number. Anytime your sales on an annualized basis are below 3,000, it just doesn't make sense. I can't ever make the math work. Canada is the same thing, but that doesn't mean that you need to go out and get registered at $3,001. Just means that the math starts making sense. In other words, you're not going to pay more for compliance than if the province actually chased you down and you paid any penalty and interest. So everyone's got to figure it out themselves. People always say, Mike, I need you to tell me what's material. Well, to Coca-Cola, $100,000 is a rounding error. It's not a whole lot of money. It's not very material. But to most sellers, $100,000, and to me, $100,000 is a heck of a lot of money. So each seller is got to determine what's material to them. So whether that be $5,000 or $7,000 or $10,000, whatever number you feel, you can handle without it impacting your business. 3 things I say you got to look at. One is risk tolerance. If you can't sleep at night, then I say be closer to that $3,000 number. I have other clients, and this is a little bit of an exaggeration, but if you tell me you go to Vegas every week and you never lose and nothing bad has ever happened to you in your life, and you don't think that the province is going to find you, well, have a higher threshold. Maybe you're at $20,000. So, your risk tolerance has to play a big factor in here. Then we've got to look at profit margins. I mean, I speak to some sellers, and I almost think they'd be better off down at McDonald's. You know, they tell me they're trying to build profit, not profit. They're trying to build market share, and they're working for a 2% profit. Well, you know, to me, that's so much work that you guys do. To work for 2%, you got to pay yourself. Because once you raise your prices after you have that market share, a lot of times that market share goes away. But still, we've got sellers that are at that 2% profit margin. And if you figure before any penalty or interest that tax in British Columbia is 7%, well, you know, if the province comes in 3 or 4 years down the road, you know, you dug yourself a big hole. You've wiped out all of your profits in British Columbia for the last however many years. Again, the larger profit margin you have, the more room you have to set your threshold. And the last one is cash reserves. I mean, if you're putting everything back into the business, and if British Columbia came in and gave you a hard time, would you be able to pay them at that point, or would it put your company, you know, pretty much out of business if British Columbia started playing hardball? So those are the three things when you're deciding when it's time to register that you need to look at. It's different for everybody.
That's all good advice there. And if someone's skating on 2% profit margin, I would say, yes, it's probably time to look into finding more efficiencies in their business, because that's just not worth it.
Absolutely.
To your point, it's a lot of work for 2%. But, you know, depending on what someone's margins are, if they're 10, 20, 30% or whatever they are, to your point, it's what is it going to eat away at if they did come after you for whatever reason. And I truly believe if you go with the spirit of what is generally the right thing to do, like someone probably needs to look at their US based philosophy on sales tax. So if they're registered in all 46 states, and to your point, they won't sleep at night if, you know, that Kansas, I don't mean to pick on Kansas, but like if you think Kansas is going to come after you, then maybe be concerned about Manitoba and Saskatchewan. But if you're not, and you think of it just in terms of, okay, as I get bigger, I'm going to register in more places where it makes sense, because at the end of the day, I want to do the right thing, then you're probably going to end up being fine. So we've talked about the GST and the HST, and now the PST, which really becomes alphabet soup, because all of the four, or well, not all of them, but three of the four kind of call it something different. So that's all sales tax related. So what gets charged on top of the sale, and then, you know, there's the input credits and all that too. But how is that going to affect, let's just use a US seller as an example, because most of the people listening to this will be either US sellers, or maybe they have a US based company and they're selling on Amazon.com. How does that affect income taxes, either in Canada or in the US, generally speaking, for your run-of-the-mill seller who has a US based company?
In general, there is the tax treaty that you can fall back on. So what the tax treaties are designed to prevent is the double taxation of income. So you don't want to tax it in the U.S. and in Canada, and vice versa. So these are, you know, reciprocal type agreements, and there is a treaty between the U.S. and Canada. So although there may be a filing responsibility, you generally won't have to pay any income tax because of the tax treaty.
Okay, good deal. So generally speaking, and I've got a service where I help people, you know, with getting up and running, and I've called Revenue Canada many times, and I try to drill them a little bit. I can never even get a straight answer as to when someone might have to. The one lady I talked to just said, I can't even think of a reason why someone registering the way your average seller in the U.S. would register. But Uncle Sam still wants his money though, right?
Oh, yeah. So the tax has to be paid somewhere. So if it's not being paid in Canada, then Uncle Sam wants it paid here. And that's what the tax treaty does. It says if you don't have a permanent establishment, or a dependent agent in the other country, then that other country doesn't have a right to claim your income, and therefore the income gets paid in the home country. The tax on the income gets paid in the home country. So that's generally going to be Article 3 or Article 5 and Article 7, depending on which country's tax treaty you're looking at. But most countries have tax treaties, not all, but most countries have tax treaties with the U.S., and it's pretty standard. So you can go to the tax treaty. Warehouses are specifically excluded from the definition of a permanent establishment in just about every tax treaty. And so common wisdom says that the Amazon relationship does not create a permanent establishment, and therefore, since there's no permanent establishment, the foreign country doesn't have any claim on the income, and all of that income is taxable in your home country.
Okay, good deal. So generally speaking, as long as you have at least 20,000 US dollars in sales, Amazon will give you a 1099 that includes your Canadian sales, and it's in US dollars. For someone that hasn't quite gotten up to that level yet, because maybe they just started or whatever the case is, what records do you suggest people keep for the IRS?
Same books and records that you would be keeping here in the U.S. I mean, the 1099 is a document that gets sent to the IRS. However, it's not what most people use to do their taxes. I mean, you've got to know what your sales are. You got to know what your cost of goods sold are. You got to know what your expenses are. Mm-hmm. So the same records that you keep here in the U.S., you would keep for that Canadian, those Canadian sales.
Okay, great. So just to recap here, make sure I'm understanding this correctly for myself and for anyone else listening. So from a perspective of someone who's selling on Amazon in the US, they want to get registered in Canada, they'd fill out the form with Revenue Canada, also known as Canadian Revenue Agency. I know it to be Form RC1, and they check the boxes off for, they have to do, which we didn't mention earlier, but non-resident importer, as well as for GST, HST, which gets them pretty much the taxes they need to collect in Canada. The registration can take a little while. I found that the non-resident importer gets done quickly, but then it takes a little longer for GST. But they'll gladly accept your money down the road as long as you're collecting it, which is just putting in your registration number in Amazon, which it's basically your business number with RT0001 on the end, if I remember correctly.
Yeah, there's what's called a Canadian business number. That's the equivalent of a US FEIN number. Mm-hmm. And all of the tax numbers in Canada use that first 9 digits, which is your Canadian business number. And then the GST is going to be the RT000. I forget how many zeros in there, but 1.
Right.
The non-resident importer number is going to be RM00001. So getting back to that non-resident number, though, sometimes your logistics company is going to open up that account for you. So they won't open up the GST number in most instances, but they will open up the non-resident importer number. So you don't want to do a duplication of effort there. And if they've actually gotten you the non-resident import number, then you already have a business number, which speeds the process up slightly. Especially if you're looking at getting registered in British Columbia, because you can't get registered there until you get your business number. So if you've gotten that already, then you can go right away and get registered in British Columbia without having to wait on anything from Revenue Canada. So not everybody does that first. Sometimes, you know, like you were saying, it's all on one form. It's easy to do. But you don't want to create the duplication of effort there if your logistics company has already done that for you.
Good point. So you'll just register for that GST HST program with Revenue Canada. And again, if you're going to tell them you're going to give them money, they're not going to give you a hard time. So you
That's been
register.
Yeah,
Sorry.
that's been my experience.
Right. All right. So then you register for the GST, HST, and NRI. You get that up and running. They send you some documents. You just basically fill out a form saying that you'll likely be that you will be keeping your records outside of Canada because you're going to keep your records anyway. It's the same kind of records you'd be keeping for the IRS, so it's nothing too crazy
Right.
you have to worry about. You may be required to keep some sort of security bond, but try not to get too caught up in that initially. I find, because again, this is my 4th year, I haven't quite broken the threshold in what I'm paying Revenue Canada just yet, although it probably will for this year when I file next year. You'll file most likely once a year, and then you still have to remember you have to pay income tax on your profits, which you won't be filing to Canada. Typically, if you're a US-based seller, you'd be paying to the IRS. Although if you are in Canada, of course, you would pay to Canadian Revenue Agency as you normally would for your profits. So,
Correct.
Was there anything there that I missed or you want to touch on?
No, that's a real good synopsis. I think you touched on everything. One thing, as soon as you make application, make sure you go into Amazon and turn on the tax.
Yes.
So that's the one thing I would just add to what you said there. And as easy as the paperwork is, we say it's easy because we've looked at it a lot of times.
Right.
Some of the people listening, it's maybe the first time, and it may be Greek to them. And there are services out there that can help with the applications and with the returns. So it's not overly complicated, but a lot of sellers have more on their plate than figuring out all of this new stuff. So there are companies like ours, and we ourselves help with those services if someone needs them. So you might want to take a look at them yourself, see how tough you think it'll be, and if you can get through it, great. If not, reach out.
Well, great. So if somebody did want to reach out to you either with Canadian sales tax, GST, HST questions, or just US-based tax, sales tax, and more type questions, it's a little bit of a pun because that is the name of your company. Where would they go for to ask any questions to you and your team?
Well, the best place to go is our website, and it's salestaxandmore.com. It's all spelled out. And on there's some great tools. I mean, if you're in the U.S., one of the things right now are, the marketplace starting to collect tax in all these different states. So we've got some free charts up there that really track not only Amazon, but eBay and Etsy and Walmart. Are they actually collecting in these states? Which states have imposed this? What are the effective dates? So a lot of great information up there, a lot of free information. So once again, salestaxandmore.com. And there'll be places that you can, fill out an info sheet and say, hey, please contact me. Let us know a little bit about what you're looking for.
Okay, great. And I will link to that in the description, as well as potentially even have a direct contact at your organization as well that can help anyone that had any questions related to Canadian sales tax or just sales tax in general. Because at the end of the day, we want to make sure that we're as compliant as we possibly can be, and making sure it all makes sense to our situation. So really appreciate you being here today, Michael, and going through this. I know I've picked up quite a few details, and like I said, I've been doing this now for 4 years and I'm still learning it, but I don't ever think someone should let the barrier of, well, there might be something I have to learn, get in their way of expanding and maximizing their sales and their e-commerce.
No. Overall, I think Canada is slightly easier than the U.S. once you get used to this VAT idea. But taxability is a lot easier, and returns, filing frequencies. So although it may be a little bit different, difference is not always bad. Sometimes it's actually a good thing.
Yes. To your point, it is much simpler, and I've found that to be the case personally. So, Michael, again, thank you so much for being on Maximizing E-commerce today, and I wish everybody the best.
Thank you, Kevin.